Did you know there's a company in 2024 that quietly controls more wealth than most countries' entire economies? I'm talking about BlackRock. They manage over $11 trillion in assets. That's more than China's entire GDP. It's bigger than the combined economies of Japan, Germany, and the UK. And the man who built this empire, Larry Fink, doesn't just manage money. He has a say in the future of almost every major corporation on Earth. Because when you own a piece of everything, you effectively own everything. This isn't just another investment firm. BlackRock is like a shadow government for global capitalism. They have influence over which CEOs get hired or fired, which companies adopt climate policies, and which nations receive investment versus those that face financial isolation. And the crazy part, most people have never even heard of them. Today, I'm going to show you how Larry Fink built the most powerful institution in modern history, how BlackRock doesn't just invest in companies, it controls them through something called proxy voting power. Shaping every decision from executive pay to environmental policy, you'll see why governments turn to BlackRock whenever the financial system is in crisis, making it almost like an unofficial fourth branch of government. This concentration of power in one firm might be the greatest threat to economic democracy since the rise of monopolies. Understanding BlackRock's empire isn't just about finance. It's about understanding how power really works in the 21st century, and why one man's decisions in New York can affect every worker, every consumer, and every citizen on this planet. Before I explain how BlackRock came to control the global economy, you need to understand what makes them so different. It's not just about the money, it's about the power to decide how everyone else's money gets used. Most people think investment firms just buy and sell stocks, but that's only half the story. When you invest in mutual funds or ETFs, you're not just buying shares. You're giving someone else the right to vote those shares on your behalf. This is called proxy voting power, and BlackRock holds more proxy votes than any other institution in human history. Let me give you some numbers that should honestly terrify you. BlackRock owns at least 5% of nearly every major corporation in America: Apple, Microsoft, Amazon, Google, Tesla, JP Morgan Chase, Bank of America. BlackRock is the largest or second largest shareholder in all of them. And it's not just American companies, it's German companies, Japanese companies, Chinese companies. Almost every significant publicly traded corporation has BlackRock as a major shareholder. This creates unprecedented power. When Apple's board meets to decide the CEO's compensation, BlackRock votes. When ExxonMobil debates its climate policy, BlackRock votes. When Amazon considers its warehouse working conditions, BlackRock votes. And because they own shares in nearly every major company, their vote often determines the outcome. But here's where it gets truly insidious. BlackRock doesn't just vote randomly. They have developed corporate governance policies that every company in their portfolio is expected to follow. These aren't suggestions, they're essentially requirements. Because if a company doesn't comply with BlackRock's ESG, environmental, social, and governance standards, BlackRock has the power to vote to replace the entire board of directors. This is how one firm gained control over the global economy, not by owning companies outright, but by owning just enough of every company to control their big decisions. It's the most sophisticated form of economic control ever devised. Now, let me show you how Larry Fink built this empire in 3 critical phases over 4 decades. It all started with Phase 1, the risk management revolution. From 1988 to 1999, Larry Fink didn't start as some grand visionary. He began as a bond trader who lost his firm $100 million in 1986 by miscalculating interest rates. But that failure taught him something crucial. The firm that best understands risk controls everything. So in 1988, Fink co-founded BlackRock with a revolutionary idea. Instead of just trading bonds, they would build the world's most advanced risk management system. They called it Aladdin, an acronym for asset, liability, and debt, and derivative investment network. Think of Aladdin as a financial supercomputer that analyzes the risk of every single investment decision in real time. By 1999, when BlackRock went public, Aladdin wasn't just for BlackRock's own investments. Other firms were paying BlackRock to use the system. This created a powerful feedback loop. The more data Aladdin processed, the smarter it became. And the smarter it became, the more firms wanted to use it. Today, Aladdin analyzes over $20 trillion in assets, not just BlackRock's money, but investments from thousands of other institutions worldwide. This was Fink's genius. He built the operating system for modern finance. And when you control the operating system, you control everything that runs on it. How did BlackRock become the most powerful company you've never heard of? It wasn't by accident. It was a 3-phase strategy, executed with ruthless precision. Let's pick up where we left off. Phase 2 was the acquisition spree. From 2000 to 2012, armed with the world's best risk management system, BlackRock started buying up its competitors. In 2006, they merged with Merrill Lynch investment managers, literally doubling their assets overnight. But the real game changer came in 2009, right in the middle of the financial crisis. While everyone else was scrambling, BlackRock bought Barclays Global Investors for $13.5 billion. Why was this so huge? Because Barclays owned iShares, the biggest provider of ETFs or exchange-traded funds in the world. Suddenly, BlackRock wasn't just managing money for the super-rich anymore. They were managing it for millions of everyday investors through these ETFs. This single move transformed BlackRock from a bond-focused firm into the largest asset manager on the planet. By 2012, they controlled $3.7 trillion. But it wasn't just about the money, it was about the power. Millions of people who bought iShares ETFs had, without even realizing it, handed over their voting power in thousands of companies directly to Larry Fink. This brings us to Phase 3, the ESG takeover. From 2012 to today, this is where BlackRock's strategy got truly revolutionary. Fink announced that BlackRock would use its immense voting power to push companies towards environmental, social, and governance or ESG policies. Starting in 2012, he began writing annual letters to CEOs. These weren't suggestions, they were demands. Report your carbon emissions, diversify your boards, adopt stakeholder capitalism, and if you refuse, BlackRock will vote to have you replaced. The impact was immediate. In 2021, BlackRock's votes helped install 3 climate-focused directors onto ExxonMobil's board, turning a century of oil industry governance on its head. And it wasn't just Exxon, BlackRock forced similar changes at hundreds of corporations worldwide. Now, here's the troubling part. Nobody elected Larry Fink to decide global environmental policy. No one voted to give him this power over our economy. He just accumulated so many shares in so many companies that he could impose his vision on everyone else. This is taxation without representation on a global scale. But BlackRock's influence goes far beyond corporate boardrooms. They've become what some call the unofficial fourth branch of government, because every time our financial system teeters on the brink of collapse, who does the government call? Not Goldman Sachs, not JP Morgan. They call BlackRock. Let's look at the 2008 financial crisis. When Bear Stearns collapsed, the Federal Reserve hired BlackRock to manage $30 billion in toxic assets. When AIG needed a bailout, BlackRock managed its distressed assets. When the government seized Fannie Mae and Freddie Mac, they hired BlackRock to evaluate their toxic mortgages. In total, BlackRock managed over $130 billion for the government during the crisis. But here's the conflict of interest. BlackRock was also one of the largest investors in the very banks being bailed out. They helped design the bailout, and then they profited from their own recommendations. Fast forward to the 2020 COVID crisis when markets crashed. Who did the Fed turn to again? BlackRock. This time, they were hired to manage not just billions but potentially trillions in corporate bond purchases. BlackRock was given control over the Fed's entire corporate debt buying program. The scope was staggering. They could buy bonds from any company, including their own ETFs. They were even given $75 billion of taxpayer money to absorb any losses. Essentially, the government paid BlackRock to bail out the entire corporate bond market, which included bailing out BlackRock's own products. Freedom of Information Act requests revealed that Larry Fink spoke with Fed Chairman Jerome Powell multiple times right before these programs were announced. Powell's own investment portfolio includes millions in BlackRock ETFs. The conflicts of interest are so glaring that members of Congress demanded investigations. And it's not just in the US in 2020. The European Commission hired BlackRock to advise on integrating climate policies into banking regulations. The irony, BlackRock is the world's largest investor in fossil fuel companies, so they are literally writing the rules for climate regulation while profiting from the very companies those rules will affect. This isn't just consultation. This is regulatory capture on a global scale. BlackRock doesn't just influence policy, they write it. And then, they profit from the policies they helped create. This is the power of BlackRock. They operate in the shadows, shaping our economy, our environment, and our government. The question is, should any single company have this much control? Have you ever heard of the revolving door? It's how people move between powerful jobs in the private sector and high-level positions in government. But when it comes to the asset management giant BlackRock, it's less of a door and more of a superhighway. Over 100 former BlackRock executives have landed senior roles in governments all over the world. We're talking about former Federal Reserve vice chairs, top Treasury officials, and central bankers, and it's a two-way street. Government officials often join BlackRock right after leaving public service. This constant flow blurs the line between public interest and private profit. It's gotten to the point where BlackRock doesn't just lobby the government in many ways. They asterisk the government, but their influence doesn't stop there. Let's look at how BlackRock's power over corporate America is rewriting the rules of our economy. We all know about traditional monopolies. Think Standard Oil controlling oil or AT&T dominating telecommunications. They controlled one industry. BlackRock has pioneered something entirely different, something much bigger. They control multiple competing companies within almost every industry at the same time. Here's how it works. BlackRock owns huge stakes in all the major airlines: Delta, United, American, and Southwest. So when these companies make decisions about prices or routes, BlackRock's vote is a key factor for all of them. This setup actually discourages aggressive competition. Why? Because BlackRock wins no matter which airline you fly. If they all keep prices high, BlackRock's overall portfolio benefits. This pattern repeats everywhere you look. In banking, BlackRock is a major shareholder in JP Chase, Bank of America, Wells Fargo, and Citigroup. In big oil, they're in ExxonMobil, Chevron, and Conoco. Big tech, Apple, Microsoft, Google, Amazon, pharmaceuticals, Pfizer, Johnson & Johnson, Merck, you name the industry, they are there. Academic studies have confirmed what common sense suggests. This kind of concentrated ownership across competitors leads to higher prices for consumers and lower wages for workers. When the same giant investor owns all the major players, there's very little incentive for those companies to truly compete with each other. It's more profitable to quietly coordinate than to fight for market share. But the real power, the hidden lever, is in BlackRock's proxy voting. This is where they go beyond just financial interests and start pushing social and political agendas. Through their voting power, BlackRock essentially issues mandates to the companies they invest in. They require companies to hit net zero carbon emissions by 2050. They demand specific diversity targets for their boards. They push for stakeholder capitalism, which prioritizes social goals, sometimes over the financial returns of the actual shareholders. And if a company doesn't comply, BlackRock has a whole arsenal of tools. They will vote against the company's board of directors. They will support activist investors who want to shake things up. They will back shareholder resolutions that force the company to fall in line. Since BlackRock often owns 5 to 8% of a company's stock, their vote can single-handedly decide the outcome. This isn't really capitalism. It's not socialism either. It says something else, a system where unelected asset managers can impose their own political agenda on the entire economy. Larry Fink, the CEO of BlackRock, and his personal views on climate change can become mandatory policy for thousands of corporations. His opinions on social issues can become the hiring standards for Fortune 500 companies. Think about it, nobody voted for this. Most of us didn't even know we were giving up this power when we invested our savings in common ETFs and mutual funds. So how do they actually do it? Let's break down the tactics. First, there's the annual letter. Every January, Larry Fink sends a letter to CEOs that basically lays out BlackRock's demands for the year. In 2020, it was all about climate risk. In 2021, diversity reporting. In 2022, stakeholder capitalism. These aren't just suggestions. Ignore the letter and you'll face the consequences during proxy voting season. Next is their ESG scorecard. ESG stands for environmental, social, and governance. BlackRock has its own system for rating companies on these factors. Get a low score and you could see less investment, negative votes, and public criticism. The catch: BlackRock defines the rules. They decide what counts as good environmental policy or effective governance. So, companies are forced to play by BlackRock's rules to keep their score up. Finally, there's their stewardship program. BlackRock employs a small army of specialists who engage with thousands of companies every year. These aren't just friendly chats. They are meetings where demands are made, backed by the implicit threat of BlackRock's voting power. It's a system of control that operates behind the scenes, shaping our economy and our society in ways we're only just beginning to understand. Have you ever wondered what happens if a major company says no to BlackRock? It's not pretty. First, there are private meetings. If that doesn't work, the pressure escalates to public criticism. Then, friendly suggestions turn into formal shareholder resolutions. Finally, during board elections, support becomes outright opposition. It's a systematic squeeze, but BlackRock's real weapon is its control over ETFs through iShares, the largest ETF platform in the world. When they launch new ETFs focused on themes like climate investing or diversity, they create a massive river of capital flowing directly to companies that fall in line with their agenda. If a company embraces BlackRock's ESG priorities, billions in new investment can pour in through these themed ETFs, but if a company resists, they're cut off from some of the fastest growing investment products on the market. This creates a system where the personal preferences of its CEO, Larry Fink, effectively become economic law for every major corporation. Being skeptical of certain climate policies becomes financially punishing. Sticking to traditional governance models becomes an investment liability. And if a company dares to prioritize its shareholders over a broader group of stakeholders, it risks a massive capital flight. This is how ideological control is imposed, not through government regulation or democratic debate, but through the immense, concentrated voting power of index fund assets. So, who wins and who loses in this BlackRock empire? The winners are clear. Larry Fink's net worth is over $1 billion, but his wealth is nothing compared to his power. He controls more economic resources than most governments and shapes corporate policies that affect billions of people worldwide. BlackRock shareholders have also done incredibly well. The company's assets grew from $1 trillion in 2009 to over $10 trillion today. Companies that align with ESG goals, like clean energy firms, see their stock prices soar thanks to BlackRock's investment flows and support. But the list of losers is long and concerning. It starts with individual investors like you and me. When you buy a simple S&P 500 ETF, you're not just diversifying your portfolio, you're handing over your voting power to BlackRock, allowing them to vote your shares according to their agenda. Millions of people are unknowingly funding causes they might fundamentally oppose. Traditional energy companies, like oil and gas, face systematic discrimination. Even though they provide essential services and employ millions, they are starved of investment and hounded by activists because BlackRock prioritizes its environmental ideology. Small and medium-sized businesses get crushed. They can't afford the army of diversity officers, sustainability consultants, and ESG reporting systems that large corporations can. Workers also lose out. When companies focus more on boosting their ESG scores than on running their business efficiently, productivity suffers, and job opportunities shrink. Developing nations face a new kind of economic colonialism. BlackRock's climate policies can restrict their access to affordable energy, effectively blocking their path to development if they want to use their own natural resources like coal, oil, or gas. Perhaps the biggest loser of all is democracy itself. Major decisions about our economy, our environment, and our society should be made by the people we elect, not by unelected asset managers in a boardroom. When a financial firm can set policies through proxy voting instead of a government passing laws, it's like a form of taxation without representation, but for the entire corporate world. Let's imagine three possible futures for this concentration of power over the next decade. Scenario 1. BlackRock's dominance solidifies. Its assets could swell to $20 trillion by 2030. ESG investing becomes the default global standard. Larry Fink's annual letter to CEOs becomes less of a recommendation and more of a command for every major corporation on the planet. Ever wondered what the future of our economy looks like? Let's explore three possible scenarios, all revolving around one powerful company, BlackRock. First, imagine a world where BlackRock is essentially the global economic planning authority. Corporate decisions, from how much executives get paid to environmental policies, aren't shaped by the market or governments, but by BlackRock's guidelines. Traditional capitalism as we know it disappears, replaced by a system where a handful of asset managers control everything. National governments find themselves subordinate. Countries that don't fall in line with BlackRock's ESG mandates face serious economic consequences, like capital flight and investment boycotts. In this world, democratic policymaking is replaced by corporate directives coming straight from New York. Now, let's consider a second scenario. The anti-ESG backlash. Political resistance against BlackRock's immense power starts to grow. States begin pulling their pension funds from BlackRock's management. New laws are passed to limit the voting power of massive asset managers. New international competitors rise up, challenging BlackRock's dominance. In this future, economic power isn't so concentrated. ESG investing becomes just one option among many, not the only game in town. Companies go back to focusing on shareholder value and market-based decisions. Most importantly, democratically elected governments reclaim their authority over financial markets. BlackRock is still a big player, but it's no longer the shadow government of global capitalism. Then there's the third, most chaotic scenario. The system breaks down. BlackRock's sheer size and power create massive instability. With one firm holding so much influence, competition dwindles, prices rise, and the economy stagnates. The costs of ESG mandates start to hurt companies' bottom lines and their ability to compete globally. A major financial crisis hits, exposing just how dangerous it is for one firm to control so much of the global economy. Governments are forced to step in, either by breaking up these giant asset managers or by placing strict new limits on their power. This could lead to a fundamental overhaul of our entire financial system, with new rules to prevent such a massive concentration of power from ever happening again. Each of these scenarios presents a very different future for economic freedom and democracy. Right now it feels like we're living in the first scenario, with BlackRock's power growing every day. But we're also seeing signs of the second scenario as political resistance starts to build. The big question is whether our democratic institutions can reassert control before this concentration of power becomes permanent. Here's a startling fact. Larry Fink, the co-founder of BlackRock, didn't set out to control the world economy. Back in 1988, he just wanted to build a better risk management system for bond investing. But through a combination of technology, favorable regulations, and market concentration, BlackRock became something completely unprecedented. Today, the firm manages more wealth than the GDP of any country in the world, except for the US and China. Larry Fink has more influence over corporate policy than most elected officials. The firm's voting power effectively sets the environmental, social, and governance standards for the entire global economy. This isn't capitalism. When one firm can force its political views on thousands of companies, the market is no longer in control. Private political preferences are, and this isn't democracy. When corporate policies are dictated by asset managers instead of our elected representatives, the will of the people becomes irrelevant. We're left with a form of technocratic authoritarianism. ruled by unelected experts who gained their power through financial engineering, not a democratic mandate. This empire wasn't built through conquest, it grew gradually, through the accumulation of proxy voting rights that millions of us unknowingly gave away when we invested in diversified portfolios. But here's what's truly concerning. Larry Fink is 72 years old. When he retires, who will inherit control over nearly $11 trillion and the future of the global economy? Will it be someone who believes in democratic values, or someone with a more radical agenda and even fewer checks on their power? The concentration of power in BlackRock is an experiment in privatizing political authority, and history teaches us that such concentrated power is eventually abused. Understanding the BlackRock empire isn't just about finance, it's about understanding how power operates in our modern world. It's about recognizing that the biggest threats to our freedom might not come from governments, but from private institutions that have accumulated government-like power without any of the accountability. The era of democratic capitalism may be ending, and the age of asset manager authoritarianism has begun. And Larry Fink is its founding emperor. Thanks for watching. If you found this thought-provoking, make sure to like, subscribe, and hit that notification bell for more deep dives into the forces shaping our world. See you in the next video.